How's everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. I hope everyone's been having a wonderful week out there so far. I wanted to kind of cap off the week this week with an article from the Wall Street Journal that really examined Warren Buffett's early life. If anybody really doesn't know much about Warren Buffett or was just been kind of curious as to how he got started or how he made his money in life, this was a great article to look at. And I think it's really important to study Warren and other investors that have made a lot of money. Just looking at, and it's not so much about the money they've made, but just looking about their methodologies, their approach to money management. What do they consider to be a good investment versus a bad investment? How do they look at the market? What are like the pros and cons of things that they see out there? In other words, there's so many lessons to be learned just simply studying the process and the way that people went about making their money. And what I find so interesting about Warren Buffett is that he made, when you think of like Elon Musk or Mark Zuckerberg or Jeff Bezos or, a lot of the billionaires that are running around right now, if you think of, you go back to like the 19th, or I should say early, late 19th, early 20th century, with like Andrew Carnegie, U.S. Steel, you look at like the big industrialists back in that age and how they made their money. Well, Warren is kind of like right in the middle of those two ages, between like the industrial age and the tech age that basically that we currently reside in. And so I think it is very fascinating to look at how it was that he made his money. So with that said, let's take a look at this article here. So this is called "What Can You Learn from Young Warren Buffett? A Look at 10 of the Legendary Stock Picker's Early Investments Reveals His Diligence, His Patience, and His Willingness to Bet Big." So we get in here. So the late Charlie Munger like to say that to be a good investor, you have to fish where the fish are. To be a great investor, though, you have to fish where the fishing boats won't even go. That's one of the messages of a new book about the methods and thinking of an investor at the beginning of an extraordinary career. Buffett's Early Investments by Brett Gardner looks at 10 of the companies Warren Buffett bet on between 1950 and 1966 when he was in his 20s and 30s. Could anybody do today what Buffett did then? In some ways, it should be even easier. Information is universally available, trading is virtually free, and individuals have vital advantages over institutional investors. In many ways, it's vastly harder. Markets are much more efficient. Bargains are all but extinct, and everyone wants to fish in the same spots. To emulate Buffett's early success, you need to think like almost nobody else. You also need plenty of patience and boatloads of courage. Buffett declined to comment in detail on the lessons of the book, telling me in an email this week, "I will answer any questions received at the 2025 Berkshire Hathaway annual meeting about Mr. Gardner." Gardner, an analyst at Discerine Group, a private investment partnership at Stamford, Connecticut, did something clever and extremely laborious. He analyzed each of the 10 companies in the book using only the financial information that was available to Buffett before he bought them. Gardner spent many Saturdays for 7 years, I bet he did, then worked full-time in 2023 locating and scouring decades-old annual reports, analyst research, manuals of corporate financial data published annually by Moody's and other obscure sources. The 10 investments he profiles are Marshall Wells, Grief Brothers, Cooperage, Cleveland Worsted Mills, Union Steel Railway, Philadelphia and Reading Coal and Iron, British Columbia Power, American Express, Studebaker, Hochschild, Cohn and Company, and Walt Disney. Nearly all of these names are unfamiliar today, but few were household names even then. Anyone analyzing the stock could tell it was cheap, Gardner writes of Marshall Wells, but not many people did analyze the Duluth, Minnesota-based hardware wholesaler. Grief Brothers, a maker of barrels and containers, traded sporadically on the Midwest Stock Exchange. But Buffett went well beyond the obvious to analyze and amass these stocks. Decades before he was famous, he traipsed to corporate headquarters to bombard managers with questions. Under a rule enacted by the Securities and Exchange Commission in 2000, corporate executives can no longer share significant information with one investor that they don't provide to all. Yet Buffett didn't just grill management, he read every publicly available source as well. Patience was key. He showed up at Grief Brothers' facility and spent hours learning about barrels from frontline employees. In 1964, American Express was hit by a scandal over a subsidiary's involvement in vegetable oil storage. Buffett and Associated visited countless restaurants, hotels, and retailers to verify that demand for Amex travelers checks and credit cards hadn't been impaired. Union Street Railway's shares changed hands so seldom that Buffett had to run ads in a local New Bedford, Mass. Newspaper inviting local stockholders to sell out to him. It took him more than 2 years to buy a significant amount. Another critical component in Buffett's early success was the guts to bet big. As Gardner writes, great investment ideas are rare. Buffett seized on them whenever he uncovered them. In 1950, Buffett sank about a quarter of his net worth into Marshall Wells. By 1951, he had more than half his net worth in Geico, the insurer. By 1966, American Express had swollen to nearly 40% of his investment partnership's total assets. And then I think this is actually a pretty cool chart here. So this is Warren Buffett's personal portfolio as of December 31st, 1951. So you can see here he had Geico was 52.7%. And yes, those numbers are right, $13,125. Grief Brothers Cooperage, 3650 was about 15%. Thor Corp, $2,550, about 10.2. Baldwin and Company, and then Timely Close was another one. So the total portfolio was $24,888. He had Des Moines Railway bonds, $330. Buffett Falk and Company, $293, and then dividends receivable, $140. Of course, Buffett's rapid rise, he went from managing about $500,000 in 1957 to $68 million a decade later, meant that he could throw his weight around, shaking up companies by buying big blocks of stock and influencing the board of directors is something most individual investors can't do. Yet every investor today has a luxury that was unavailable to young Buffett. You could put most of your stock allocation into a market tracking index fund. That way you can be assured that bulk of your assets won't underperform. Then with what's left, say 5 to 10% of your stock money, you can make concentrated bets on a few companies that might still be overlooked and undervalued. You can, but that's also not emulating what Warren did. I'll get to that in a minute, but let's finish this. Search in the backwaters of the financial markets where institutional investors rarely venture and exchange-traded funds haven't yet proliferated. Among them, community banks, bankruptcies and spinoffs, micro-cap companies with total market value under $1 billion, and orphan stocks that have been booted from major market indexes. These approaches are risky and require the kind of intensive analysis that Buffett specialized in. They're not for everybody, and there's nothing wrong with admitting they're not for you. But Wall Street is more obsessed than ever with mindlessly chasing whatever's most popular. As young Buffett's track record shows, you can make good money by noticing where all the fishing boats are and taking your rod and reel elsewhere. So, I will be really interested. I will definitely be checking this book out. But it's just important to note the way that Warren invested when he was a young man. Like he picked certain companies and he did a ridiculous amount of analysis in those companies. And Warren Buffett is famously known as what's called a fundamental investor, meaning that, he didn't look at, back then in those days, they had stock charts, but it was nothing like what it is today. And that would be defined as what's known as technical analysis of stocks. And, Warren did not and never really has prescribed to this technical analysis. He has always been a fundamental investor, meaning that he's looking at the financial statements of the company. He's looking at the balance sheet. He's looking at the income statement. He's looking at the statement of cash flows. He's looking at the assets that are sitting on that balance sheet, and he's trying to figure out, okay, where is this company going based on the assets that it has? What kind of business, what kind of industry are they in? What does the industry look like? Who is the management at the head of the company? Is that management capable? And he did wild stuff. He went down to these companies and he sat there with employees. He sat there with management. He would sit there and grill them for hours and basically ask them questions. And now, can you really do that today? In a certain way, but would you have access to the CEOs and the CFOs of a lot of these companies? No, you would not. And would these executives even talk to you if you came and knocked on their door? No, they would not. So I think that, the world has definitely changed a little bit. there's certain things that are different, but one thing that is better is the information at our disposal. Like, we have way more information available to us today than even Warren Buffett did back in those days. And it's real easy now to get annual reports and 10K filings. I mean, you might have to pay a few bucks here and there to get some subscriptions to certain services or something like that, but nothing that is going to break the bank or anything like that. But what Warren did was, again, he analyzed companies. He saw value, or he found value in these companies, and then he invested and put together his portfolio based on that. Now, someday I'll go a little bit deeper on there. There's more to this story than just simply what he invested in. He made one very large bet on like a textile company that really blew up. You remember in the article where it said he went from managing like 500,000 to 68 million in like a 10-year period of time. Well, that was because that one big bet that he made on the textile company just absolutely just ballooned his net worth. And that's kind of what you have to do. You have to find a diamond in the rough that is a real winner that basically can propel you to, X amount of wealth and then kind of build from there. But I always have to put out the disclaimer that, hey, I'm not a financial advisor. I'm not giving out financial success to people. I'm not a lawyer. I'm not an accountant. So please don't don't go out and start formulating a financial strategy based on all this stuff. Like I said, I just think that Warren Buffett is a great person to study. And remember, Warren Buffett learned from one of the best. He learned from Benjamin Graham. Benjamin Graham wrote the all-time classic Wall Street Journal book, The Intelligent Investor. If you've never read that book or looked at it, make sure you go check that out. I will definitely do a review of The Intelligent Investor at some point. But like I said, I hope you find this interesting. I'm definitely going to check out this book and and see if I could do a review on it, maybe sometime in the next couple of months here, and let you know what I guys think. There are some other really good Warren Buffett books out there that I have a few, and I'll be sure to share those with everybody if anybody has more interest in this. But with that being said, I'll basically wrap up with this. If you like this episode, please make sure to like, share, and subscribe. That always helps the channel. Please make sure to leave any comments down below, as I always love getting back to everybody. Remember, we are on YouTube, Rumble, and all major podcast platforms. And as always, make sure to check out tomorrow night. The Strategy Room will be live Saturday night, 8 p.m. right here on YouTube. Please be there to check it out, as that is the main show of the channel. And I present all of like the weekly news and economic indicators and all the good stuff that everybody always looks forward to. But with that being said, I hope everybody has an awesome day out there, and I will see everybody hopefully tomorrow at 8 o'clock. So see you then.